Hi there, it's Kristen Cooper, your certified mortgage planning specialist and certified advisor. Super excited to go over this information today. As we all know, it's been quite an interesting market right now in 2022 as we start off the year. And for the past year or two, it has definitely been a bit of a challenge for a lot of buyers. And the reason why is affordability. When interest rates are at the lowest point, as they have been for so long, then it creates more affordability for more buyers to be able to afford. If you buy in a market where it's a lower interest rate, it's more affordable than even buying in a market at higher prices because interest rates tend to be higher when prices are even higher as well. So it's really important to look at where are we, where have we been, and where are we going, because there's a lot of uncertainty of fear that's made with decisions right now in the market that we're in. So we want to look at what does it mean based on where we've been with low rates, where we are with rates starting to go up, and where we anticipate interest rates to be, and what does that look like. I think it's really important to understand the market so that you can make good decisions. So what we're looking at here is just going to be a simple analysis. And as a mortgage planning specialist, we're looking at the total cost analysis of every transaction. It's not just here, you're qualified, here's your payment out of pocket. We want to make sure that you're not only in the right mortgage, but that we're making you the best return on investment as well as building wealth for a long-term legacy. So if you have questions around that, if you haven't worked with somebody in regards to mortgage planning and mortgage advising, I'm happy to help with that. If we look at these scenarios here, really what we're looking at is where are we, or where were we? So as we know, interest rates were at a lower point the last couple of years. So we'll just go with 2.875. They were actually even lower than that at one point, but we'll go with 2.875 as a 30-year fixed rate mortgage. Of course, these rates were specific to your qualifications and will be different for each qualifying person. But if we look at a 30-year fixed at 2.875, estimating property taxes and insurance really at a $530,000 purchase price, we'd be looking at a payment of about $23.79. Now, where we're at now, we'll just say about 3.5%. But again, it's based on qualifications and many factors, so we need to look at your numbers specifically to make sure we see what you would qualify for, as it's not a guarantee to lend. But let's assume 3.5. Now that payment for the same $530,000 price went from $23.79 to $23.95. Now let's just assume that based on what people are saying, interest rates are expected to go up to the 4.125, 4.375% range within a year. So if we look at interest rates going to a 4.125 at the same price, now that payment's jumped up to $26.74. So where we were at $23.79 for the same price home, you'd be looking at $26.74. Of course, we have appreciation, which we've had remarkable numbers of appreciation the last several years, and we're still continuing to see appreciation, and it's still expected to continue to appreciate. Hopefully around normal 1-digit versus 2-digit numbers is what's anticipated. And that doesn't take into account here, so we do need to adjust for that as far as does it make sense to wait or buy. If you're buying in a higher price with higher rates, your payment and affordability is going to be impacted. Your payment would be higher and you would be able to afford less. So rent versus own, or buying now versus waiting in a year, when it comes into interest rates and appreciation, is going to be more than what's here. But just to look and see where we're at as far as interest rates go and affordability and where we're at, this is what we're looking at here. So we were at 2.875. We're, mid threes now. We may climb to 4.125, 4.375. So obviously you can see here that impacts your payment and affordability. Now, the one thing that I want to look at here is what is it going to cost me if I can't find a home? Because I know there's a lot of buyers that have a ton of clients that are looking for homes and just can't find a home right now. And so it's creating a lot of anxiety and stress and frustration and worry. And so we really want to look at this from many angles. Yes, it should be a motivator to continue your search to purchase if you're renting, because now you're going to be investing into your future, your legacy, your wealth. And so the return on investment for buying is the biggest wealth factor that most people can actually obtain, because you already need housing over your head. But we also want to look at, if I can't find a home, is it worth me continuing the search? Should I continue? What does that look like? Because I think the worry and fear comes from not knowing what that may look like. And so we also want to address that. So if we look at the payment here over or the savings over 60 months. Now, the reason that I choose 60 months is the likelihood that someone stays in their home usually is 4 to 8 years. So we don't really want to amortize this over 30 years. I think that's skewed thinking, and we want to look at more realistic numbers. What if, I buy when rates go higher, and, what does that look like? So let's just assume you stay in this property for 5 years once you do buy. Obviously, if you're able to buy in a lower rate, you're going to have more savings than you would if you were to buy at a higher rate. However, what I want you to think of and what I want you to consider, and kind of the positive, if you will, from this, or the optimistic view of this, is let's say that we did end up buying in a 4.125 rate. So we end up waiting and we have to buy down the road and it's a higher rate. Now, this negative 25,958, that is how much it actually will cost you. That's why it's a negative. So it will cost you roughly $26,000 more purchasing in this rate environment than it would to be purchasing at where we were at the 2.875. So, 26,000 is a big deal. But if you're in this home for 5 years, is the home going to appreciate for at least 26,000? Absolutely. That's a low appreciation based on the numbers are anticipating for moving forward. So even if you were to buy in a higher rate market, it still makes sense because the amount that you're not only going to appreciate over 5 years, but the portion of your payment, which is known as principal, that you're paying down every month, which is now your equity in the home, definitely is going to recover what you end up paying, even if we end up in worst case scenario of 4.375. So I put this out here because I want you to see the numbers. I think it's important to see the numbers so that you can make an educated decision and being able to see, okay, how much is this really going to end up costing me in the long run? Of course, affordability is a factor, but I say this to keep you motivated on the path to creating wealth. The only way for most Americans to really build wealth is through homeownership. You're not going to save your way into wealth. You could put away a couple $100, $500 a month for the difference of what you would pay from rent into housing, and it's not going to end up giving you a return like housing will. So it does make sense to continue to search if you're renting a property right now, if you end up having to relocate for a job. Now, there may be instances where you're in your home and you're comfortable in your home and it was really just like, hey, we were at home and, it was COVID and we just got cramped in our space and we were really thinking about purchase. Maybe it's not a need that you need to purchase right now. Maybe you're comfortable where you are, so this may not be a factor for you. But if you're someone that's currently renting, somebody that has to move for a specific reason, I want you to see the numbers so that you can see that this isn't the end all be all. This doesn't mean that you continue or don't continue your search. This doesn't mean that you don't move forward with your plans to purchase and build wealth. The sooner that you can build the wealth, the sooner that you can purchase, obviously the better return on investment you're going to get. But as you can see in these numbers, it's still going to be a return on your investment, even if interest rates go up. So it's going to be okay. You don't need to have too much worry, stress, or fear about what that looks like moving forward, or being concerned that it's not going to make sense for you if interest rates go up. Housing is still going to be the best way for you to build wealth. And if you want to look at specific numbers for you and you want to look at the mortgage analysis that's going to be based on your specific parameters, reach out to me. I'd be happy to go over the numbers. I always say numbers don't lie. It's really important to understand what that looks like so you can make well-educated decisions. And I'm more than happy to sit with you, take the time to be able to guide you through what those numbers look like so that you can make the best decision for you and your family and start building your wealth and your legacy.